Hi, this is Karim Rahimtullah, co-founder of The War Room, along with Brian Bottarelli. If you don't know what The War Room's about, you can click on the link below. It takes you right to the site. You can find out all about it. And in The War Room, we discuss a lot of different things. We do a lot of trading. And today I'm going to get into what we call Simply Answered, Simply Explained. This is where we talk about different strategies that we use, and we try to simplify it so that everybody can use it. And if you're ready to go, let's talk about a topic called Strangles, okay? Strangles and also Straddles. But let's stick to Strangles to begin with. Strangle sounds like such a mysterious word, like you're gonna kill somebody, right? But it's not. A strangle is one of the most profitable types of trades that is event-driven. Remember that, event-driven. So something has got to happen. So when something happens, a stock can react sharply one way or the other. It's either gonna go up or it's gonna go down. So how do you know which way it's gonna go? Well, you kind of don't know which way it's going to go, and that's the whole point of a strangle. Because you don't know which way it's going to go, you're going to bet on both sides of the trade. Because if it moves enough on one side, it's going to cover the entire cost of the trade and a ton more. Okay, so this is how it works. So let's say AT&T is reporting earnings tomorrow. Okay, so AT&T is trading at 30 bucks. So we don't know if AT&T is going to report great earnings or horrible earnings. I mean, it's done everything in the past. It's reported great earnings, stock's gone up 10%. It's reported horrible earnings, it's gone down 20%. You don't want to get stuck in the game of trying to guess which way it's going to go, because chances are you're probably going to guess wrong. So why make that guess? Just go both ways. Okay, it's the best strategy out there. So this is what we would do. We would buy a call option on AT&T. Remember, a call option is a bet the stock is going up. And we would buy a put option on AT&T. A put option is a bet the stock is going down. So in a strangle, and AT&T is trading at 30, what you would do is you'd buy a call option that's out of the money and a put option that's out of the money. What does that mean? Well, if it's out of the money, it's not trading at the same price. It's not trading at 30 bucks, right? So the strike price you would use on the call option is 31. On the put option is 29, okay? So let's say the call option costs you $1 and the put option costs you $1. It means you've put into the trade $2. So basically what you want to see happen is when AT&T opens tomorrow morning after it reports earnings, the stock price goes up past $31 by at least $2 to 33, which gives you your break even, and hopefully even more so you can make money on it. And if it goes down, you want it to go down to 29 minus $2 or to 27 or below to cover your $2 that you have invested. So that's what a strangle is. A strangle is a bet in both directions. You don't care which way it's going to go. That's the beauty of it. I don't care which way it's going to go. All I care about is that it's going to go up or down more than $2, which is what I have invested in the trade. So let's move on to the second part, which is a straddle. Okay, so straddle, the concept is the same as a strangle. Okay, you want up or down. You don't care which way it goes. But the difference is a straddle is when you buy a put option or you buy a call option with the exact same strike price. So in this case, let's say AT&T is trading at 30 and you want to do a straddle. So a straddle, think about it this way. If you're straddling a fence, okay, you got one leg on one side, one leg on the other side, right? Same thing. So AT&T is at 30, you buy a $30 put option, you buy a $30 call option. That's it, simple as that. And now you're betting that it goes either below 30 or above 30, but goes enough to cover the cost of your entire trade. And there you have it. A straddle and a strangle, these are the two of the best strategies to use for an event. It could be earnings, could be a huge announcement by a biotech company about a drug. It could be a massive announcement coming from the government or the Fed or whatever it is. You don't know what's going to come down the pike, but you want to make money regardless of which way it goes. Now, it could not go either way. You could end up having this price stay exactly the same. That's the worst possible thing in the world. If the price doesn't change, you're toast, okay? That's all I can say. You're toast because the stock didn't move. It didn't cover your straddle. It didn't cover your strangle. So you basically lost money on the trade. So remember, we want trades that have a high probability of moving sharply in one direction or another. And my partner Brian, he's an expert on this stuff. He lives and breathes strangles. So there you have it. Everything you ever wanted to know about spreads and strangles. So if you want to know more, click on that link below. It takes you to Trade of the Day. That's our publication where we send you daily trading advice and a lot more. So join us next time for another explanation of Simply Explained, Simply Answered. Thank you.